Welcome to the deep dive. Today, we're jumping into something that's really been making waves, certainly in the financial world lately.
Absolutely. It's hard to miss.
Yeah, over the past year or so, we've seen this really interesting pattern. More than a dozen public companies, globally, announced they were buying Bitcoin.
Big news each time.
And what happened next? Their stocks. Well, they didn't just tick up, they went, frankly, parabolic, just shot up. And many are still climbing.
It really has been quite the phenomenon. It signals a real shift, I think, in how traditional finance views Bitcoin. It's not just some fringe asset anymore.
Not at all. It's becoming like a strategic reserve for some of these places.
Exactly. They're basically betting a chunk of their future on Bitcoin's continued growth. It's a bold move.
It really is. And just when we thought that story was, settling down a bit, we get this new twist.
Ah, yes, the altcoin angle.
Precisely. Both Cardano ADA and Polkadot DOT have recently announced their own plans to start accumulating Bitcoin.
Which, really opens up the conversation, doesn't it? It's not just about traditional companies anymore.
Right. Now we're talking about crypto projects themselves, these DAOs, decentralized organizations, using their community treasuries to buy Bitcoin.
It's a fascinating development. Different structure, different motivations, potentially.
So that's what we need to unpack today. Because the big question, the one everyone seems to be asking is, okay, will ADA and DOT and maybe other altcoins that follow this path, will they see that same kind of crazy explosive growth?
That parabolic move we saw with the company stocks.
Exactly. So today, our mission is to do a deep dive into why those Bitcoin treasury companies did so well in the first place. Then we'll look at whether altcoins holding Bitcoin could realistically follow suit.
And maybe touch on, how high they could possibly go, or if that's even the right way to think about it for them.
Absolutely. Because, like you said, the underlying asset is the same Bitcoin, but the entities buying it, their reasons, their structures, they might be worlds apart.
And that could lead to very different outcomes. Understanding those differences is, I think, the key.
Okay, so let's start with section 1. Why did those Bitcoin treasury company stocks perform so well? Let's unpack that first.
Sounds good. And the core reason, when you boil it down, is actually, well, it's pretty straightforward.
Is it? The results were dramatic.
The results were, but the underlying logic is simple. By buying and holding Bitcoin on their balance sheet, the future valuation of these companies is seen to inherently increase.
Okay, but that's based on a big if, right?
A very big if. It assumes Bitcoin keeps doing what it's historically done, appreciate in value. Investors are basically making a direct bet on that trend continuing.
And that historical trend, it's pretty hard to ignore. What are the numbers again?
Well, over the last decade or so, Bitcoin's annualized return has been hovering around 50%, 50.
50% annualized. That's staggering.
It is. Compare that to basically any other major asset class. Stocks, bonds, gold, real estate. Bitcoin has just blown them out of the water over that time frame.
So the market sees that number.
Exactly. And markets, as we know, are always trying to look ahead. They're forward-looking.
Right. They price things in early.
Precisely. So when a company, let's say MicroStrategy, which really kicked this whole thing off, or Block, formerly Square, when they announce they're buying a bunch of Bitcoin, or even just signal they plan to buy more,
the market reacts instantly.
Instantly. Investors start pricing in the future growth of those Bitcoin reserves, but they do it today, right now.
Okay. So the stock rally isn't just hype about the announcement itself. It's the market saying, okay, this company now holds more of this asset that goes up 50% a year, so the company must be worth more down the line.
That's the logic, yes. They're pricing in a higher future value for the shares based on the expectation of those increased Bitcoin holdings appreciating significantly over time.
It's almost like a feedback loop then. The expectation drives the price, which reinforces the strategy.
It can feel that way. But again, and we have to keep stressing this, it all hinges on that crucial assumption that Bitcoin will keep delivering those kinds of returns.
Which is absolutely not guaranteed.
Not at all. If Bitcoin's growth slows dramatically, or if it enters a prolonged bear market, that whole investment thesis for these companies gets shaky fast. But for now, that expectation of 50% annualized returns is the engine driving these stock prices.
Okay, that makes sense. But it does raise a really interesting question, probably one a lot of you listening are thinking.
Let me guess. Why not just buy Bitcoin directly?
Exactly. If Bitcoin is the magic ingredient, why bother buying the company stock? Why not just hold BTC yourself or buy one of those spot Bitcoin ETFs that are available now?
Yeah, that's the logical next question, isn't it? And here's where it gets, as you said, really interesting. The short answer involves thinking about what these companies are beyond just Bitcoin holders.
Okay.
The key difference is that Bitcoin treasury companies are typically actual operating businesses. They have cash flows coming in from their primary activities.
Ah, the side hustle idea.
Precisely. So you can think of these Bitcoin treasury companies as being like spot Bitcoin ETFs that also have a side hustle that generates additional income. Income that can then be used to buy even more Bitcoin to back the shares of the company.
That's a great analogy. So they're not just static holders of Bitcoin like an ETF is.
Not at all. Take MicroStrategy. Their main business is business intelligence software or block payments and financial services. These businesses generate real, ongoing revenue.
And instead of just putting that cash into, I don't know, savings accounts or something.
They strategically allocate a portion of it to continuously buy more Bitcoin. It's not just a one-off purchase. It's potentially an ongoing accumulation strategy funded by their core operations.
So their business cash flow essentially acts like a feeder mechanism, constantly adding more Bitcoin to their treasury.
Exactly. They can grow their Bitcoin stack without necessarily having to issue new debt or sell more shares just to buy Bitcoin, at least not all the time.
Mhm.
And that's when investors get excited about this self-funding accumulation potential.
It's like buying Bitcoin on leverage, but the leverage comes from their operating business, not just financial borrowing.
In a conceptual way, yes.
Mm.
You're betting on Bitcoin's appreciation, plus the ability of the company's side hustle to keep acquiring more of it for you. It's an active strategy.
And of course, each Bitcoin treasury company has its own unique side hustle, right? Their core businesses differ.
Absolutely. Which adds another layer of diversity and analysis for investors looking at these stocks.
Okay, so that combination, Bitcoin's potential plus a cash flow engine to buy more, explains the stock performance. But it leads us right into the next critical point. How are they actually financing these sometimes massive Bitcoin purchases?
Right. Because understanding the financing mechanisms is crucial to figuring out if altcoins like Cardano or Polkadot could realistically replicate this.
So let's dig into that. How have these public companies been funding their BTC buys?
Generally speaking, it boils down to two main methods: issuing debt or selling more shares of their own stock.
Standard corporate finance stuff, then.
Pretty much. MicroStrategy, for instance, famously used convertible notes quite heavily.
Can you break that down simply for us? What's a convertible note?
Sure. Think of it like a corporate bond. The company borrows money, pays interest, but there's a twist. Holders of these notes can, at a later date, choose to convert that debt into shares of the company's stock, usually at a specific preset price.
Okay, so it's debt that might turn into equity later.
Exactly. It's a way for the company to raise cash now. If their stock price goes up a lot, driven by Bitcoin hopefully, then note holders might convert, and the company settles the debt with shares instead of cash.
Sounds clever, but what's the catch for existing shareholders?
The catch is potential dilution. If those notes convert, more shares are created, meaning each existing share represents a slightly smaller piece of the company pie.
Right, so selling shares directly or using financing that could lead to selling shares later, like convertible notes, that's generally seen as, well, less optimal from a shareholder perspective.
It is. Dilution is generally something investors try to avoid if possible. While it's often a necessary tool for companies to raise capital, it's a fundamental constraint for these traditional structures when they want to buy more Bitcoin beyond what their cash flow supports.
Okay. And this is where the altcoins might have an edge, potentially.
This is where it gets really different, yes. Because altcoins, theoretically, have more options to finance Bitcoin purchases. And some of those options could be, as you say, more optimal because they might avoid dilution altogether.
How so? What could an altcoin do differently?
Well, let's take Cardano as an example. Cardano has its native coin, ADA. ADA itself has value. So Cardano, or rather its community treasury managed by the DAO, could potentially use some of its ADA holdings as collateral.
Collateral for what?
Collateral in DeFi, decentralized finance protocols. They could lock up ADA and borrow stablecoins against it.
Stablecoins like USDC or USDT, pegged to the dollar.
Exactly. And then they could use those borrowed stablecoins to buy Bitcoin for the Cardano community treasury.
Ah, so they get the cash to buy Bitcoin without actually selling their ADA. They're borrowing against it instead.
Precisely. It's leveraging their existing assets without putting downward sell pressure on ADA's price, which selling directly would do.
That sounds powerful. But surely there are risks. What if ADA's price drops? Couldn't they get liquidated?
That's the key risk management part. You'd have to manage the loan-to-value ratio, the LTV, very carefully.
Meaning don't borrow too much against the collateral.
Exactly. If you keep the LTV very low, say you only borrow $10 million worth of stablecoins against $100 million worth of ADA collateral, then ADA's price would have to crash incredibly hard before you'd face liquidation. It creates a significant safety buffer.
So if managed prudently.
If managed prudently, this approach could allow Cardano to accumulate, tens, maybe even hundreds of millions of dollars worth of Bitcoin over time.
Without selling a single ADA indefinitely.
Theoretically, yes.
Right.
Which is a stark contrast to the traditional companies often forced into that less optimal path of share sales or dilutive debt.
That is a fundamental strategic difference in how they can build up those reserves, a potential game changer.
It really reframes the possibilities for capital acquisition in the crypto space.
Okay, this is fascinating. Let's pivot now specifically to Cardano's vision, because it sounds like they're thinking big. Section 3, Cardano's Decentralized Sovereign Wealth Fund.
Yes, Charles Hoskinson, Cardano's founder, started talking about this pretty openly back in mid-June. The idea of creating a, quote, decentralized sovereign wealth fund for Cardano.
A sovereign wealth fund, but decentralized. Interesting phrasing.
It is, and he explicitly mentioned that part of this fund's mandate would be to buy Bitcoin.
Okay, and we need to understand the scale here. Cardano's treasury is substantial, right?
Yeah. At the time of these discussions, the community treasury held something like 1.8 billion ADA.
Billion with a B.
Yep, which back in June was worth close to $1 billion US.
Mm-hmm.
So they have significant resources to draw upon.
So the plan is to fund this new sovereign wealth fund using that existing treasury.
That seems to be the logic. The initial talk was about committing maybe $100 million worth of ADA to get it started.
$100 million to kick things off. But here's where we need to be really clear, based on what you said earlier.
Yes, this is crucial.
The purpose of this fund is not just to mimic those Bitcoin treasury companies, right? It's not solely about stacking sats to pump the ADA price.
Absolutely not. That's a critical nuance. Only a portion of this initial $100 million capital is earmarked for buying Bitcoin.
So where's the rest going? The majority, even.
The majority is planned to go towards buying stablecoins, but specifically stablecoins native to the Cardano ecosystem.
Why? What's the goal there?
The primary goal is to give a major boost to Cardano's own DeFi ecosystem to increase liquidity, basically.
And that needs boosting.
Well, if you look at the data from places like DeFi Llama, which tracks this stuff, there was only around $30 million worth of stablecoins locked on Cardano at the time.
That does seem quite low for a major blockchain.
It is relatively low. And interestingly, that might have been somewhat by design, or at least a consequence of caution.
Caution about what?
The Cardano community seems very aware of the potential risks of becoming too reliant on large, centralized stablecoin issuers like Tether, USDT, or Circle, USDC. There are concerns about censorship or control if those issuers gain too much influence over the chain.
Ah, the decentralization ethos kicking in. So they've been trying to foster their own native stablecoins instead.
Exactly. The ecosystem has been working on launching its own algorithmic or collateralized stablecoins. But bootstrapping liquidity for new stablecoins is always a challenge.
So this sovereign wealth fund, buying up those native stablecoins, is intended to be the solution, to provide that crucial initial liquidity.
That appears to be the core strategy. It's an investment in their own internal financial infrastructure.
Okay, so let's walk through the mechanics. They plan to sell $100 million worth of ADA from the treasury, use most of that cash to buy Cardano native stablecoins, pumping liquidity into their DeFi system.
Right. Increasing the soil fertility for their digital garden, if you like that metaphor.
I do like that. And then a smaller portion of that $100 million goes to buying Bitcoin.
Yes. And that Bitcoin could also serve a purpose within their ecosystem, perhaps bootstrapping specific DeFi protocols that work with Bitcoin, like lending or derivatives, platforms built on Cardano that utilize BTC.
Now, the obvious concern, selling $100 million of ADA sounds like it could crash the price.
Charles Hoskinson addressed that directly. He explained the plan is to do these sales very gradually, over multiple weeks, and importantly, working with professional market makers.
To minimize the price impact.
Exactly. The goal is to execute these sales carefully, so they have little to no negative effect on ADA's market price. It requires sophisticated execution.
And there's another interesting part to this plan, isn't there? Something about yield.
Yes. The idea is that the stablecoins purchased by the fund won't just sit there. They'll be put to work, likely lent out or staked in DeFi protocols to earn yield, interest. And that yield, the profit generated from the stablecoins, would then be used to buy back the ADA that was initially sold.
Whoa, okay, so it's designed to be a self-replenishing cycle. Sell ADA, buy productive stablecoins, use the yield from stablecoins to buy back the ADA.
That seems to be the long-term vision. It could create a sustainable way to grow the ecosystem's liquidity and utility without permanently reducing the Treasury's ADA holdings.
That's quite an elegant design if they can pull it off. When do we get more details?
Hoskinson mentioned more specifics would be revealed at the Rare Evo conference, which is happening in Las Vegas from August 6th to 10th, so fairly soon.
Okay, so we'll be watching for news from that. What about the potential impact on ADA's price then?
Well, the specifics are still pending, as we said. But just the news itself, the ambition of creating this fund, could certainly generate positive sentiment and potentially support ADA's price in the longer term.
It signals serious development and investment in the ecosystem.
Exactly. And practically, those yield strategies, if successful, could provide ongoing buy pressure for ADA, helping support the price, especially during market downturns.
And maybe prevent projects from dying off during bear markets like what happened last cycle.
That's a key potential benefit. Providing that stable funding source and liquidity could make the whole Cardano ecosystem more resilient through market cycles. It's less about hoarding gold and more about, as you said, building that fertile digital garden.
The Bitcoin is a nutrient, but the main investment is in the soil. The stablecoin liquidity allowing everything else to grow and even regenerate the seeds, the ADA.
That captures it perfectly. It's a long-term play on ecosystem health.
Okay, fascinating approach from Cardano. Now let's compare that with Polkadot. Section 4, Polkadot's Strategic Bitcoin Reserve. Their angle seems a bit different.
It does. Discussions about Polkadot holding Bitcoin actually started earlier, maybe back in January this year.
What prompted it?
It kicked off with a community member basically pointing out that DOT, Polkadot's coin, was consistently losing value relative to Bitcoin. So the proposal was simple. Use some treasury funds to buy Bitcoin as a hedge.
A hedge against further underperformance versus Bitcoin?
Mm-hmm.
A more defensive initial posture?
Seemingly so. And it's worth noting the Polkadot community already had some experience actively managing its treasury. They had previously voted to convert some DOT into stablecoins.
So they were already diversifying slightly away from just holding DOT.
Yes. And if you look at Treasury.com now, their treasury holds around $100 million in assets, mostly DOT, yes, but also some stablecoins. And interesting,
What's that?
some of those stablecoins in the Polkadot treasury are already being lent out in DeFi protocols to earn yield.
Wait, so Polkadot is already doing the stablecoin yield thing that Cardano is just now planning with its big fund?
Effectively, yes,
Right.
albeit likely on a smaller scale and perhaps with less fanfare. But the mechanism is there. Newsflash, right? Polkadot is effectively doing what Cardano wants to do anyways regarding that stablecoin yield.
That is interesting. Okay, so fast forward to June, and there's a more formal proposal about buying Bitcoin.
Correct. Another community member put forward a concrete plan. It involved slowly purchasing TBPC, that's a form of wrapped Bitcoin, on Polkadot.
Right, tokenized BTC usable within the Polkadot ecosystem.
Exactly. The plan was to buy it gradually over the course of a year using 500,000 DOT in the Polkadot treasury.
And how much was that worth?
At the time, around $2 million US.
Okay, so significantly smaller than Cardano's initial $100 million concept. $2 million over a year.
Much smaller, yes. More of a toe dip, perhaps. Now, an on-chain proposal for this was expected back in the second week of June. But as of our recording, we haven't seen it appear on the official governance site.
So what does that suggest?
It probably means discussions are still ongoing behind the scenes, likely trying to build solid community consensus before putting it to a formal vote.
But is there support for the idea generally?
From what we can gather, yes, there seems to be pretty widespread support in the community discussions. It feels like it's probably a matter of when, not if, it gets proposed formally.
And connecting this to the bigger picture, didn't Polkadot's founder also talk about this kind of thing?
He did, actually. What makes this interesting is that Gavin Wood, Polkadot's founder, proposed something similar way back in an interview in November 2023.
What did he say?
He advocated for the Polkadot treasury to diversify its holdings more broadly. He mentioned things like fiat currency, gold, even NFTs, alongside other cryptocurrencies.
So a much wider diversification strategy than just Bitcoin.
That was his vision. Right now, the treasury only holds DOT, stablecoins, which represent fiat, and one other altcoin from its own ecosystem. So buying Bitcoin would be the next logical step in that diversification plan.
Given its accessibility and the general buzz around Bitcoin treasuries, yeah, it seems like the obvious first move.
Bitcoin would likely be first in line, yeah.
So what's the potential impact on DOT's price here? Similar to 80.
Pretty similar outlook, I'd say. You might see a small, short-term pump based on speculation if the purchase gets approved.
But the actual selling of DOT would be minimal.
Very minimal. Selling just $2 million worth of DOT spread out over a year, that would likely have next to zero impact on the price given DOT's trading volume.
And the accumulated TBTC.
That could provide a bit of a long-term tailwind, maybe some underlying support for DOT and the Polkadot ecosystem, adding that Bitcoin collateral.
But we need to keep the scale in perspective.
Absolutely. I mean, let's be real. Neither Polkadot nor Cardano, at least with these initial plans, are talking about buying billions of dollars worth of Bitcoin like some of the public companies did.
Right, 2 million, even 100 million initially. It's significant, but maybe not enough to trigger those truly parabolic moves on its own.
It's entirely possible these smaller allocations, relatively speaking, will have no major direct impact on DOT or ADA's price as a result. The market might just shrug it off.
Okay, that's a crucial reality check. Which brings us neatly to Section 5, the crucial differences and the future outlook.
Right, so we've established Cardano and Polkadot are buying Bitcoin, but for different primary reasons than the companies.
And at a different scale, potentially. But what else are they missing compared to those companies whose stocks pumped so hard?
Well, arguably the most important missing ingredient is that side hustle we talked about, that operational cash flow engine that can be used to continuously buy more Bitcoin.
Ah, right. The companies had profits from software or payments or whatever that they could funnel into BTC purchases.
Exactly. Remember, the company's stock rallies were fueled by investors extrapolating Bitcoin's 50% historical returns onto ever larger BTC stacks held by the company. The more BTC they could predictably buy using their business profits, the higher investors predicted the future share price.
And Cardano and Polkadot, they don't really have an equivalent side hustle generating massive external revenue in the same way?
Not in the same way, no. As we've seen, their treasury strategies are fundamentally different. They aren't primarily using Bitcoin as a mechanism to pump their coin price via continuous accumulation funded by external profits.
They're using it more for internal ecosystem growth, liquidity, diversification, hedging.
Precisely. At least for now, that seems to be the focus. Growing their ecosystem, hedging volatility, it's an internal investment, not an external asset accumulation play designed purely for price appreciation of ADA or DOT.
Now, we did talk about how altcoins could theoretically finance purchases cleverly using DeFi.
Yes, they have more options than just selling equity or issuing standard debt. They could do DeFi magic, collateralized loans, maybe even some CeFi strategies.
But there's a catch there too, isn't there?
The catch is that even those clever strategies ultimately require significant, reliable cash flows to work sustainably. You need money to pay interest on loans or to manage collateral positions safely, especially if you want to scale up significantly.
And most altcoins just don't have that kind of reliable, large-scale cash flow.
Very few do. Their revenue might come from network transaction fees or staking rewards, but that's often volatile and might already be earmarked for validators, stakers, or core development. It's usually not a huge surplus profit engine like a traditional company might have.
Let's revisit that Cardano DeFi loan example, using ADA as collateral to borrow stablecoins.
Okay.
We said they could keep the LTV low, say 10%, borrow $10 million stablecoins against $100 million ADA. Seems safe.
Relatively safe from liquidation, yes, but there's still a cost.
The interest on the loan.
Exactly. Stablecoin borrowing rates, especially during bull markets, can easily be around 10% per year, sometimes higher.
So on a $10 million loan, that's $1 million a year in interest payments.
Potentially, yes.
Yeah.
Maybe hundreds of thousands at minimum, depending on the rates. And the Cardano Treasury would need to consistently generate that cash just to service the debt.
Which would be hard.
Very hard. And you have to ask, is that the best use of funds? Wouldn't that $1 million be better spent directly funding grants, developers, or other initiatives within the Cardano ecosystem?
Probably. It seems more efficient to be the lender earning yield on stablecoins rather than the borrower paying interest.
Which, ironically, is exactly what Cardano is planning to do with the majority of its sovereign wealth fund capital. They want to be the lender, not the borrower.
Right. So That DeFi financing route, while theoretically possible, seems practically challenging for large-scale, continuous Bitcoin accumulation for most altcoins.
It does seem challenging to sustain purely for accumulation purposes.
And Polkadot's situation,
Yeah.
even tougher.
Arguably, yes. If their treasury is smaller, the potential amount of DOT they could sell without impacting the price is likely smaller. They probably don't have the capacity to spend huge sums building up a massive Bitcoin treasury via complex financing, especially when they're already spending significantly on marketing and development.
So it really hammers home the point. Cardano and Polkadot are pursuing fundamentally different strategies here, not just different from the public companies, but different from each other, too.
Absolutely. Cardano seems focused on boosting its internal DeFi ecosystem with stablecoin liquidity. Polkadot seems more focused on treasury diversification and hedging its reliance on DOT. Bitcoin is just one piece of those broader, distinct goals.
Okay, so this brings us to the really big question looking forward. Are we likely to see other altcoins follow suit and announce their own Bitcoin treasury strategies?
My guess.
Right.
Probably yes, we will see more announcements like this.
Why do you say that?
Because fundamentally, more smart contract platforms want more Bitcoin accessible on their chains. Bitcoin is still the king, the most valuable, most recognized crypto asset.
And having it usable within their own DeFi ecosystems is attractive.
Hugely attractive.
Yeah.
We've already seen the supply of wrapped Bitcoin, WBTC, TBTC, RenBTC, etc., grow massively on chains like Ethereum, Solana, Avalanche, and others.
What's it used for there?
All sorts of things in DeFi. Trading pairs, collateral for loans, components of index funds, yield farming strategies. Having deep Bitcoin liquidity makes a chain's DeFi ecosystem much more robust and appealing.
So an altcoin project creating its own Bitcoin treasury is just one way to help bootstrap that on-chain Bitcoin liquidity.
Exactly. It's a direct way for the core protocol, or DAO, to inject BTC liquidity into its own ecosystem.
And here's the multi-million-dollar question. Will doing so actually benefit the price of their own native coin or token? Will it make, say, AVX or SOL pump just because their treasuries hold some BTC?
That's the much harder question. And based on our discussion so far, I'd say probably not significantly, or at least not for the same reasons that the company's stocks pumped.
Why not?
Because from the perspective of pumping the native token price, a Bitcoin treasury strategy only really works if the altcoin can mimic the company's. That is, if it has a strong independent revenue stream to continuously buy more Bitcoin over time.
That side hustle again.
That side hustle. And as we've discussed, very, very few altcoins truly fit that description. You mentioned Hyperlend earlier.
Yeah, generating maybe close to $1 billion in annualized SHI revenue, according to DeFi Llama. That's serious cash flow.
It is. But even then, what are they likely to do with that revenue?
Probably buy back their own token, HYPE, right? To directly support its price.
Exactly. If you're a project generating huge profits, the most direct way to reward your token holders is often through buybacks or burns of your own token, not necessarily by buying a different asset like Bitcoin, unless it serves a very specific strategic purpose for your protocol's function.
That makes sense. There's also the correlation argument, isn't there?
Right. Some argue it's almost pointless for an altcoin DAO to hold Bitcoin purely as a reserve asset, because historically, most crypto assets are highly correlated anyway. They tend to move up and down together.
So Bitcoin doesn't offer true diversification within the crypto market itself.
Not in the same way that holding, say, US dollars or stablecoins would,
Right.
which leads to another interesting distinction.
Yeah.
For a publicly traded company trying to diversify away from fiat, holding a crypto asset like Bitcoin makes sense. But for crypto DAO, whose main asset is its own volatile native token,
Diversification often means holding traditional assets, like fiat currencies in the form of stablecoins.
precisely, it flips the logic. Stablecoins provide the stability and lack of correlation that a DAO treasury might seek, more so than Bitcoin would.
So if a DAO's main goal is diversification, Bitcoin probably wouldn't get a huge slice of the pie anyway.
Probably not, which reinforces the idea that the main reason an altcoin would choose to accumulate significant amounts of Bitcoin is specifically to grow its own Bitcoin-related DeFi ecosystem.
To get more Bitcoin liquidity onto its chain for users and developers to play with.
Exactly. And even then, are large treasury purchases the only way or even the best way to achieve that?
What are the alternatives?
Well, many DeFi protocols simply offer incentives directly. Things like yield farming programs, offering high APYs paid in their native token for users who deposit wrapped Bitcoin into their liquidity pools.
So they attract BTC liquidity organically by rewarding users rather than buying the BTC themselves.
Often, yes. These incentive programs can be funded by token emissions and managed at the individual protocol level without needing a big, potentially contentious main DAO vote to spend Treasury funds on buying BTC directly.
Okay, so pulling all these threads together, the final verdict on altcoins going parabolic due to Bitcoin treasuries seems pretty clear.
It does. So no,
Okay.
we probably won't be seeing altcoins mimic that explosive stock performance just because their treasuries hold some Bitcoin.
Because the context, the motivations, the financing mechanisms, the scale, and the alternative strategies are all fundamentally different from those publicly traded companies.
Exactly. They're playing a different game.
But you did mention a silver lining here.
Yes, there absolutely is one. While the native coins, ADA, DOT, etc., might not pump parabolically from this, the ecosystems built on these chains could benefit significantly.
How so?
All that injected Bitcoin liquidity, whether bought by the Treasury or attracted through incentives, is fantastic news for the DeFi protocols operating on Cardano, Polkadot, or any other chain that embraces this.
More liquidity means better trading, more lending borrowing opportunities, more complex financial products can be built.
Precisely. It makes the whole DeFi ecosystem on that chain more vibrant, more useful, and potentially more valuable. The benefit flows more to the applications and users within the ecosystem rather than directly and solely to the price of the base layer coin.
So it's still bullish, just bullish for a different reason and potentially for different beneficiaries within the ecosystem.
That's a good way to put it. It's a strategic, long-term investment in network utility, not a short-term speculative play on the native token price based on mirroring corporate treasury strategies.
Okay, let's try and recap the key takeaway for everyone listening.
Sounds good.
Bitcoin treasury companies saw their stocks soar because they combined Bitcoin's massive historical returns with their own operational cash flows, allowing investors to price in continuous self-funded Bitcoin accumulation, directly boosting the perceived future value of the company shares. It was a direct bet on BTC appreciation scaled by the company's earning power.
Whereas altcoins like Cardano and Polkadot, these seem to be using Bitcoin treasury strategies quite differently. It's more nuanced. They're focused on internal goals, growing their DeFi ecosystems, providing liquidity, diversifying their treasuries, hedging risk.
Which means their approach is fundamentally different and, crucially, much less likely to result in those same kinds of parabolic price pumps for their native coins, ADA or DOT. The direct link between buying BTC and pumping the native token isn't really there in the same way.
It's a different mechanism with different goals. More about building that healthy digital garden than just stacking gold bars.
So, thinking about this, what really stands out to you, the listener, about these very distinct approaches? It raises a fascinating caution for the future, doesn't it?
It really does.
Do you see a scenario where maybe altcoins could evolve their strategies, perhaps find ways to generate more consistent revenue, enabling them to more directly mirror those stock pump dynamics? Or is this ecosystem-focused approach likely to remain the dominant path for them?
And if it is the ecosystem path, does that mean the real winners from these strategies will ultimately be the specific DeFi protocols and applications built on top of Cardano, Polkadot, and others, rather than the base layer tokens themselves?
It's definitely something to chew on as this intersection of traditional finance concepts and decentralized crypto networks continues to develop. Lots to think about there.
Indeed. The motivations behind holding assets in this new digital age are becoming increasingly diverse and strategic.
Well, if you found this deep dive insightful and it gave you some food for thought, please make sure to follow, like, and share. We appreciate the support.
Absolutely.
And you can also follow What Bitcoin Taught Me. For more insights across various platforms, we're on Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.
Lots of places to connect.
We'll be back soon with another deep dive into the fascinating world of Bitcoin and digital assets. Thanks for tuning in.